A study by the Stanford Economic Policy Institute found that 7% of financial advisors have been linked to misconduct between 2005 and 2015. For some firms, this number was as high as 20%. That means that 2 out of 10 financial advisors gave bad financial advice or blatantly misled their clients. You can pretty much walk into any bank and find a financial advisor, walk into any investment firm and be hounded by financial advisors, all wanting to get a chunk of your hard-earned money in promises of perhaps higher returns or better tax management. Is this true though? Does the research and do the statistics back the idea that we need financial advisors in a world where stocks can be bought at the click of a button and all financial advice, well, most of it, is available for free online? Let's find out. One of the main factors when it comes to people choosing financial advisors is the trust element. NerdWallet did a study that found that 79% of people choose their financial advisor based on trust. They don't care about the cost, they don't care about the returns, they just want to trust someone with their money. But who exactly is this person that they're trusting? In order to gain this trust, financial advisors have to do certifications. The most popular certification is the Certified Financial Planner certification, or the CFP, after which anybody can start practicing as a financial advisor. It's 12 to 18 months of study in financial practice, enough to make someone qualified to manage million-dollar portfolios or even $100,000 portfolios. Even if you argue that, well, they do gain some expertise, a lot of these people posing as financial advisors claim that they're wealth experts or financial experts after an 18-month degree. Not even a degree, I should say an 18-month certificate. Let's say for the sake of argument that in fact 18 months is enough to manage million-dollar portfolios. There needs to be an assessment of what the trust that is being built is being used to do. The biggest way in which this trust that we talked about is exploited is the flat fees when it comes to financial advice. Most financial advisors charge 1 to 2% of the entire value of the portfolio that they're managing. What do you get for this 2%? Are returns significantly higher or statistically higher than a simple ETF or exchange trade fund? An ETF provider like Vanguard or BlackRock can provide investment opportunities in the same indices like the S&P 500 or the Nasdaq 100 at a much cheaper price. For example, this popular S&P 500 ETF, VOO, by Vanguard has a management fee of 0.03%. So a financial advisor is charging 66 times more than a simple ETF. Is the return the financial advisor gives you more than 66 times the return that the ETF gives you? Now, of course, 66 times is not realistic. Is it a couple percent more than the ETF would give you? Is it even 1% more than the ETF would give you? Although there's no longitudinal study that shows us an active managed portfolio versus a passively managed portfolio, 70% of financial advisors often and always recommend ETFs and buy ETFs for their clients. So essentially, you are paying someone 66 times the fees for buying the same ETF that you could have bought yourself. The other 30% of financial advisors are mostly relying on mutual funds, which are even worse for your portfolio. The average expense ratio for a mutual fund is 1.5%. Some mutual funds can also go as high as 3%. And the significantly higher fees can erode your gains over time. A research by Morningstar found that even a 1% increase in fees can result in 20% less wealth over the course of 30 years. And why a lot of financial advisors prefer mutual funds is because of the sales loads. This is where a commission fee is paid to the advisor on the purchase or the sale of a mutual fund. To give you an example, on a $1 million portfolio, let's say that the financial advisor charges a 2% fee. They get $20,000 for the year for buying the same ETF that you could have bought for yourself practically for free. If you're enjoying this video so far, smash the like button and the subscribe button. Every subscriber matters and helps get this video to the right people. And the other 30% that are not buying ETFs are buying mutual funds on which they also make commission. Let's say that they buy a mutual fund for you that tracks the S&P 500 or the total market for $100,000. They're going to get 2 to 5% off that total purchase price. Again, something that you could have bought for yourself for 0.03%. The SEC has a useful tool for playing around with fund fees, and using this I found out that if you invested $10,000 with a 2% fees, you could have lost $14,000 after 30 years, which is more than the amount that you actually invested. And to further drive the point home, I did a hypothetical with $100,000 at an annual return of 7%, in line with the US market over the last few decades. If you have a 1% annual fee, your total amount is going to be somewhere around $700,060. At a 2% fee, which does not seem like that big of a jump, $100,000 only grows to $510,000 because you have less money for that compounding effect. Bump that amount to 3%, that $100,000 only grows to $387,000. Now you see why that 1% of fees that the financial advisor takes from you can be very harmful for you, especially if you have decades to live. We've covered how financial advisors interact with the stock market and how you can pretty much buy everything that they're buying yourself. But what about the other products that they're pitching? A lot of financial advisors are incentivized to pitch high risk, high reward investments, and not high reward for you, but high reward for themselves in terms of the commissions that they're getting. One of the most popular investment vehicles is variable annuities. Variable annuities are a type of insurance product that financial advisors pitch as a way of deferring taxes, since taxes on this type of insurance investment are often deductible only on withdrawal. One of the facts they conveniently leave out is the high fees that is associated with variable annuities. There's a whole list of fees. In fact, there's a whole layer of fees, including mortality risk, admin fees, management fees, you name it. And these costs often amount to more than 3% of the amount invested. Variable annuities often underperform the market and are often recommended by financial advisors because of their high commission structure. Most financial advisors make 5 to 7% on variable annuity sales. Once again, highlighting that misalignment of incentive between us, the investors, and the financial advisor that is basically acting as a salesperson. Another type of insurance product that they love is fixed income annuities. These types of annuities do have some level of protection for the principal, but returns are often capped and linked to an index. Once again, financial advisors love this because they get high commission on selling these types of annuities. And investors often end up losing over time with these sorts of investments. If let's say that the return of the annuity is capped at 3% or 4% and the inflation level is 2 to 3%, the real return for the investor is actually only 1%. Compare that with the stock market that has a return of 7 to 8% on average, the investor is actually protecting their money from inflation. And this is not just me saying this. The Department of Labor did a comprehensive study on annuity sales, and they found that retirees that invested in annuities average a return rate of 4 to 5%. And over the course of 20 years, they struggled to keep up with inflation. In fact, they did not keep up with inflation. You might be wondering, well, the return seems okay at 5% because inflation is definitely lower than 5%. This is where the hidden fees and those admin costs that we talked about come into play. Taking those into account yearly, the average retiree that invests in annuities is not making any money. One of the points that's perhaps not talked about enough is the advisors themselves don't have any foresight that the average well-informed investor does not have. This came into play in the 2008 financial crisis. Many advisors pushed for municipal bonds that they saw were safe investments with high returns. Well, we all know what happened, and a lot of these municipal bonds turned into junk bonds. I'm not blaming the advisors for this, I'm just saying that there's some situations that even the advisor cannot predict, and the best course of action might be investing in a broad market-based ETF. Perhaps a more evil side to this is guaranteeing clients returns in the 7 to 8% range, while in fact giving them only 3 to 4% because the rest of the 3% is taken up by the advisor. In 2017, Consumer Reports found that these guaranteed returns were a surefire way of getting more people to invest into funds, but the hidden fees, the admin costs, and other yearly costs ate up into their returns and only gave them an average of 3 to 4%. In my opinion and in my research, this is the most evil side of giving financial advice and financial advisors in general, targeting vulnerable populations. Advisors often target people with limited financial literacy or certain portions of the population, for example, old people and retirees. These people often have a limited understanding of how investments work and are usually more emotional than the average investor because of a fear of not having funds in retirement, not having enough money to pay rent, etc., etc. This makes it even more possible for financial advisors to manipulate their choices and make them invest in high commission, high risk investments. This is not just me saying this. A 2018 report by the SEC found that older Americans on average are more likely to invest in high commission investments that are often riddled with complex fees and a complicated structure that just confuses them. Another 2017 report confirmed this finding and stated that retirees that invested in annuities and other high commission investments face poor growth and often were strapped for cash. Retirees are one group that they target. The other group is just people that lack financial literacy. FINRA reported that 60% of Americans are financially illiterate and are more likely to fall for claims like guaranteed income or a guaranteed investment return. Financial advisors may use this illiteracy to sell them high commission, high risk products. And both of these groups are being targeted through one particular thing: fear tactics. Telling retirees they don't have enough time and they're not going to have enough money to live on, or telling someone that is financially illiterate that if they don't invest now, they're going to lose on millions of dollars is what gets people to invest in the first place. Even if you solve the commission problem, the conflict of interest will still remain. The financial advisor makes money by selling you products and by managing your portfolio. Most financial advisors don't link their commission to the portfolio performance. They get their commission either way. No matter if your portfolio goes down 10% or up 50%, they're going to get a chunk of your money. How can we solve this conflict of interest? Well, in 2018, the Department of Labor introduced the fiduciary rule. This rule stated that financial advisors had to act in the best interest of their clients and recommend products that are most beneficial for their financial growth. More importantly, they also had to disclose any conflict of interest. For example, if they're getting higher commission on selling a particular product, they had to disclose that. This seems awesome that financial advisors have to disclose any conflict of interest when it comes to high commission products. But through lobbying and other means, somehow in 2018, the Fifth Circuit Court of Appeals removed this rule, meaning that financial advisors are no longer bound and no longer have to disclose conflict of interest. And by 2019, only 15% of financial advisors were bound by fiduciary duty, meaning that 85% of advisors do not have to disclose conflict of interest, and the client has no way of knowing if the advisor is actually doing what's best for them. And what's worse is that most clients working with non-fiduciary financial advisors don't even know that they fall under this umbrella. They think that their financial advisor is bound by that duty, is bound by not putting their own self-interest ahead of the client. Well, in fact, that's not the case. The CFP has actually established a fiduciary standard, but most financial advisors don't have to get that designation, meaning that most people are in fact not protected. I guess in a world where everybody wants a chunk of your money, financial advisors, realtors, lawyers, everybody wants their fees, what you can do is protect yourself. Be aware of the decisions that you're making before giving anybody your money. And if you can do it yourself in a world where everything is literally at your fingertips, why give someone 2% of your hard-earned portfolio for the rest of your life for buying the same ETFs that you could have bought in literally 3 seconds? That is a question that I have in my mind when it comes to financial advisors, and hopefully one day they might have an answer for that. As always, smash the like button and the subscribe button. Every subscriber matters and helps get this video to the right people also interested in finance, learning how to invest and save more. I hope you enjoyed this, and I'll see you in the next one.